Hey, what's up, everybody? It's Doug Shoemaker with the Shoemaker Loan Team at Homestead Financial Mortgage, and welcome back to 1 Minute Monday or 2 Minute Tuesday since I was out yesterday. Hey, I've been helping people buy and refinance homes for over 25 years now, and here's a reality. Most people think that they need to go talk to 5 or 10 or 50 different lenders just to make sure they're getting a good deal. Well, we actually do that for you. We're going to actually shop your application across multiple different top banks and investors so that you can make a smart decision without having to fill out a stack of applications and getting bombarded from calls and texts and emails from 20 or 30 people that you'll probably never ever talk to again. Now, each week I break down the mortgage and housing headlines in a way that you can actually use the information. So if you just want to know what time it is, I'm going to land the plane here for you in about a minute and a half. If you want to know how the clock works a little bit more, stick around. And if you're a clock builder and you just have to know all the details, well, I'm going to go there towards the end of the video as well. So what time is it right now? Well, mortgage rates, they're stubborn as can be. And according to Mortgage News Daily's National Average Rate Survey, today we're sitting right around 6.32% on a 30-year fixed rate conventional. On FHA around 5.91, and on VA's 30-year around 5.93. So not a whole lot of movement, but also not a whole lot of real improvement yet either. And as always, everybody, these are national averages, not personal rate quotes. Your personal rate's going to depend on your credit score, your loan size, the down payment, loan type, whether or not you're going to live in the home, and a handful of other details that do really, truly matter. If you're thinking about buying a home or refinancing and you're calling and looking for rates and people are just asking 2 or 3 questions, buyer beware, because all of those details I just mentioned really, truly matter. Now, the bigger story this week is this. Oil's back over $100 a barrel. Stocks are a little bit lower. Mortgage bonds are a little bit lower. And that's definitely not the combo that we want to see when we're hoping for lower interest rates. Now, at the same time, pending home sales rose 1.5%. Retail sales came in strong at 1.7%. And jobless claims, they're still low, but continuous claims, they remain elevated. So the market's basically asking one big question right now. Is inflation going to stick around longer than we want? So for my friends that just want to know what time it is, let's keep it simple. Rates are holding kind of in a range, but they are under some pressure. Housing demand is still alive. Oil's becoming a bigger factor once again. And this week is loaded with data. We've got the Fed meeting, GDP, and PCE. Now remember, GDP, that's gross domestic product. It's basically the scorecard for how the economy's growing. And PCE is personal consumption expenditures, and that's the Fed's favorite way to measure inflation. So yeah, this week truly does matter. Now, if that's all you needed, your work here is done. But before you go, I hope you'll take a quick second to like, subscribe, and maybe share this with somebody else that you know that's also looking to buy or refinance and make sense of this crazy market. But if you want to know how the clock works, just stick around a little bit longer. Now let's go ahead and start with housing. Pending home sales, they actually rose in March. And remember, that's contract signed, it's not closing. So this is more of a forward-looking report. And the message is pretty simple here. Buyers have not disappeared. Now they are cautious. They're probably more payment sensitive than ever. And yeah, they're a bit frustrated, but they definitely haven't left the building. And the issue here isn't demand. The issue is inventory and affordability. Now, we still have a market where there's a lot of sellers that are sitting on 3% mortgage rates, like it's literally the last piece of cheesecake at Thanksgiving. Now, here's what changed this morning, though. As I said earlier, oil, it's reached over $100 a barrel again, and that really does matter. Now, Iran is literally running out of spaces to store all the oil they're producing. They're actually using tankers as kind of floating storage devices. Now, exports, they're also being restricted through the Strait of Hormuz. And here's the problem. If Iran's forced to shut down production, it's not like flipping a switch. It can actually damage the oil fields, and it can reduce long-term output and take months and billions of dollars to restart. So now you've got real supply risk here. Now, at the same time, the UAE, they did just announce that they're leaving OPEC starting May 1st, and that should definitely increase production, but that's long-term. Right now, markets don't like uncertainty, and uncertainty in oil, well, it creates uncertainty in inflation, and inflation creates pressure on mortgage rates. So now let's go ahead and talk about the consumers for a second. Now, retail sales came in strong at 1.7%, but a big chunk of that is gas. So people may not actually be spending more, buying more things. They might just be spending more to get to the place to buy more things. And that's definitely just not the kind of economic strength the bond market gets excited about. Now with jobs, ADP is actually showing about 39,000 jobs added per week, and that puts us around 160 or 170,000 per month. And that's a stronger number than recent reports. So now we've got a labor market that isn't cracking either, which means that the Fed doesn't really have a ton of urgency to cut the Fed funding rate. So housing appreciation data, it also came out this morning. Case-Shiller, which actually tracks home price appreciation across major cities, well, it showed basically flat growth month to month. Now, FHFA, which also measures home prices using data from conforming loans, they also showed flat growth. Now, even after rates dipped earlier this year, we still had flat growth. And that tells us that affordability is still doing its job. It's slowing price growth. Now, here's the sneaky positive. Rents are actually down 1.7% year over year, and this is the lowest level since 2017. That matters a lot because shelter costs are one of the biggest pieces of CPI. CPI, of course, being the Consumer Price Index, which is one of the main ways inflation's actually measured. So when rents come down, that can actually help inflation cool over time, but vacancy rates are still elevated. So again, we've got mixed signals. Now let's go ahead and bring it back to mortgage rates. Mortgage bonds actually tried to break above their 200-day moving average this morning. Well, they failed, unfortunately. Now they're drifting back towards their support level. Now the 10-year Treasury, it's broken above 4.33%, and it's actually got room to move upward towards the 4.41% level. If that happens, that likely means more upward pressure on rates in the short term. So here's the bigger picture, the clock builder version. Rates feel stuck because the market's trying to solve four problems all at once. Inflation, which isn't gone, economic growth, which it's still holding, the labor market, which isn't breaking, and oil, which is now back in the spotlight. And the bond market's basically saying, hey, show me a pattern, not a headline. Until we get that, rates are going to move in ranges. Windows are going to open, windows are going to close. And if you don't have a plan, you're probably going to miss those windows. So here's what I'm telling clients literally right now. If you're under contract, this is definitely not a week to get cute without a strategy. Now, if you're further out, we can float for a bit, but you need to be very, very careful about that and make sure you're working with somebody that understands the market. Nobody's got the crystal ball that actually works right now, so we need to understand these trends. Now, we locked a bunch of people late last week, but now we can float again, but with eyes wide open for sure. And for buyers and homeowners, don't just ask what's the rate, ask what's the strategy. Should we lock? Should we float? Should we use seller concessions or maybe buy down the interest rate? Should we preserve cash? Because think about this, the best loan, it's not the one with the lowest rate on paper. It's the one that actually closes on time without blowing up and setting your hair on fire the last week. So here's the takeaway. Rates are still range bound, but they are under pressure. Oil just became a bigger player again. Housing demand is still there. Inflation signals are mixed. And this week's data, it could move markets really quickly. So everybody, that's all I've got for you for today. But don't forget, if you're military, law enforcement, or a firefighter, or somebody who supports our local heroes, ask about the Home Foundation and how we're helping make homeownership more affordable for those who serve our community. I'm Doug Shoemaker with the Shoemaker Loan Team at Homestead Financial Mortgage. Thanks for watching. Like, follow, subscribe, and please share this with somebody else who's just trying to make sense of this crazy market. And remember, the goal's not to perfectly predict rates. Like I said, nobody's got a crystal ball that works anymore. And think about this. Most stress and anxiety, it comes from a lack of preparedness. That's why the goal here is to be prepared when opportunity shows up. Have a great week, and I'll see you on the next 1 Minute Monday.